Good afternoon, folks. Welcome to the weekly wrap-up for June 10th, 2022. Hope everybody's having a great week out there. Not the best week in the markets, unfortunately. And we got a fresh round of bad data around inflation. So is what it is, folks. You can thank your friends at the Federal Reserve and our friends in Washington for putting us over this barrel. So awesome. All right, if it's your first time watching, please give me a big old thumbs up, like, share, subscribe, all that good crap. And, anyway, sorry. Got a little frog in my throat today. All right, well, let's go ahead and jump in and see how the market did today. Unfortunately, it was not all that great. A lot of red down this screen. Starting off with the Dow Jones, it finished down 2.73% at 31,392. S&P 500 was down 2.93%, closed down at 3,900. NASDAQ was down 3.52%. Again, tech is going to take a beating with all this, with the rate increases and everything that's going on. So you may want to adjust your portfolios, folks. The NASDAQ, like I said, was down 3.52%, closed at 11,340. Small caps were down almost 3% also. The VIX rose 6.36% today. It's currently sitting at 2775. I think at its peak, it was up around the high 29s earlier today. Moving on to the other exchanges in the Americas, Canada was down 1.41, Brazil down 1.55, Mexico down 1.67. Moving over to Western Europe, Germany down 3.08, UK down 2.12, France down 2.69, the Euro Stoxx down 3.36, Netherlands were down 2.52, Spain down 3.68, Italy down 5.17%, Switzerland down 2.1, Portugal down 3.39, Belgium was down 2.14, Austria down 3.96, Sweden down 2.61, and Denmark down 1.94. Looks like the Russian exchanges were split today. The MOEX was down slightly at down negative or in the red 0.37. The RTSI was up 4.64%. All right, let's move over to Asia. Japan was down 1.49. Australia down 1.25. The New Zealand finished flat at down 0.06. Looks like the Chinese markets, avoided a lot of this carnage. The Shanghai was up 1.42. The SE component up 1.9. The China A50 up 1.6, and the DJ Shanghai up 1.48. The Hang Seng was the lone laggard. It was down 0.29%, and the Taiwan weighted came in down 0.97. So pretty ugly day. Not the prettiest day in the markets, unfortunately. So, like I said, folks, if you've been playing along, this is not to be unexpected. So, is what it is. All right, well, let's go ahead and look at the weekly chart. The Dow Jones finished the week down 4.98%. The S&P 500 looks like it's going to finish down about 5.67%. The NASDAQ, down 7.05%. Dow Utilities, looks like down 4.07%. And the Dow Transports, looks like they're coming in down 7.6%. So, as far as all the major indexes here in the U.S., looks like, ranging from about 4 to 7% loss for the week. Not all that great. Let's go ahead and jump back out and take a look and see where we stand for the year. All right. So far right now, it looks like the Dow Jones is down about 13.5% so far this year. The S&P 500, let me get rid of that. Looks like it's down 18 1/3, and the NASDAQ, we're down about 27.5% on the NASDAQ. So The NASDAQ is definitely in recession or bear market territory. The others are, kind of in between. So it's not all that great right now. So, all righty, let's go ahead and jump into some economic data for the week and see how that turned out. We did cover some of this during our weekly articles earlier in the week or yesterday. Initial jobless claims came in above forecast at 229,000. Forecast was 210. And we can see, we've really since the beginning of May have been above 200,000. And this appears to be the highest reading in the last, 6 weeks-ish time frame. So nothing overly concerning at the moment, but again, we don't like to see jobless claims rise. Continuing claims came in just a hair over forecast at 1.306 million. The forecast was 1.305 million. Certainly not the end of the world, and it does appear that the trend is continuing to fall on the continuing claims. So that is some good news. The consumer price index, which came out today, we came in at an 8.6 number. The forecast was only supposed to be 8.3. So, if you remember all those articles that I've been quoting from where inflation has probably paused or peaked, it's slowing down. It hasn't. We're in the same spot that, we've been in for quite a while. And until the Fed gets off their butts and really, jacks up the interest rates to quell the economy, I really don't see much of a change going forward. So it's going to be a while. And, a lot of the articles I cover, it seems like the bias of a lot of the, journalists who write these is that, we should probably take a pause, slow down. I've seen a lot of those articles over the last, few months, even before the tightening really began with the Fed. They were already talking about how, when is it going to end, even before it got started. So I know those in the banking world don't like interest rates going up because it hurts their bottom line. But, what would you rather have? High inflation and the stock market look good? Or would you rather have inflation or deflation? You're probably going to take a hit on your stock valuations just because everything is inflated right now. So, all right. The U.S. consumer sentiment number came out today. It came in at a 50.2. The forecast was 58. So quite a ways off. So not too good there either. All righty. So let's go ahead and jump into a few articles that I found interesting today. First one is just the market recap. S&P 500 slumps as surprise jump in inflation. Again, I don't know who was surprised by this. To keep Fed on rate hike trail. The S&P 500 fell sharply Friday as data showing inflation unexpectedly hit a fresh 40-year high. Is expected to keep the Federal Reserve leaning hawkish and scuppered hopes of a rate hike pause later this year. Wow. The consumer price index rose 1% in May, above expectations for a 0.7 increase, taking the year-on-year consumer prices through May to 8.6%, the fastest rate since 1981, and above economists' forecasts of 8.3. In a worrying signal for the Fed, the factors pushing inflation above fresh 40-year highs are broadening beyond just supply chain issues, with shelter, food, and gas leading the gains. Quote, the Federal Reserve is committing to reducing demand to meet a supply-constrained world. This inflation reading will strengthen that resolve, end quote. Yelena Malayev, economist at Grant Thornton, said in a note. Treasury yields jumped on bets that the Fed would be forced to deliver 50 basis points at each of the next three meetings, putting growth sectors of the market, such as tech, which are vulnerable to rising rates, on the back foot. Apple, Meta, and Microsoft, each down more than 3%, led the losses in big tech. Consumer discretionary also led the deep slide in the broader market, led by travel and leisure stocks on fears that red-hot inflation would put a further squeeze on consumer spending. Caesars Entertainment, Royal Caribbean, MGM Resorts, and Booking were among the biggest losers in the sector. Quote, the pace of consumer spending is going to slow. We've already seen that in the choices they are making, end quote. Chief strategist at Spouting Rock Asset Management, Reese Williams, told Investing.com in an interview today. Quote, there's been a few anecdotes that even on services like cruises, demand is down for the next year, Williams added. Quote, people are a little bit shocked by how much things cost, end quote. Financials were driven lower by banks as the Treasury yield curve continued to flatten on bets of a potential recession ahead. Again, if you're caught off guard by the potential of a recession in the next, 12, 24 months, you've been living under a rock, or you've been listening to the not smart people on television, because those folks are paid to lie. Signature Bank, Capital One Financial, and Synchrony Financial slumped with the latter, which is sensitive to cryptocurrency, also suffering added pressure from a rout in crypto. Bitcoin fell more than 2%, while Ethereum fell more than 6% to a 52-week low. Not good news out there, folks. And again, the people fighting the tightening of the Fed and the tightening up of all the quantitative easing that we've had, it's just, we have to, it's like going on a diet or getting in shape to run a marathon. You just don't wake up one day and can run 23 point or whatever miles, 26.3 miles. So, 26.2 to be exact. You just don't, wake up one day and do that. You have to actually build up strength and tolerance to, to running that far. So again, in this, I want it now economy, and people are just unfortunately not, are unfortunately ignoring what's in front of us. All right. Next article: oil falls as U.S. inflation data surges. China imposes lockdowns. What are they locking down for now? Oil prices fell on Friday after U.S. consumer prices rose more than expected, and China imposed a new COVID-19 lockdown measures. Awesome. Brent crude fell $1.06 to settle at $122.01 a barrel. U.S. WTI crude fell 84 cents to settle at $120.67 a barrel. Both benchmarks still pose weekly gains, 1.9% for Brent and 1.5% for WTI. For the day, oil prices sank along with Wall Street stocks after news that the U.S. consumer prices accelerated in May. Gasoline prices have hit a record high, and the cost of food has soared, leading to the largest annual increase in about 40 years. That raised expectations that the Federal Reserve will tighten policy more aggressively. Good. Quote, the concern is that could be a forward indicator of consumer habits, and even though gasoline demand is strong now, it's a sign in the future that gasoline prices don't stabilize, then consumers will be cutting back, said Phil Flynn, analyst at Price Futures. He's also on Fox Business a lot. In another red flag for demand, Shanghai and Beijing went back on COVID alert on Thursday. Parts of Shanghai imposed new lockdown restrictions, and the city announced a round of mass testing for millions of residents. China's crude oil imports in May were up nearly 12% from a year earlier when they were low. Quote, this does not indicate that oil demand is picking up. Instead, China is likely to have acted opportunistically, buying crude oil from Russia at significantly lower price than the global market level in order to replenish its stocks. Commerce Bank analyst Karsten Fritsch said. Oil had risen more than $1 earlier in the session from fears of a potential disruption supplies in Europe and Africa. Norway's oil output could be reduced if workers go on strike on Sunday. Boy, that's good news. The world needs energy, and they're going on strike. The Norwegian Oil and Gas Association said. Some 845 of roughly 7,500 employees on offshore platforms plan to strike from June 12th if annual pay negotiations fell. Oil output at Libya's Safir field has been reduced after the ports of Ras Lanuf and Ez Sadir were closed, and a group threatened to close the Hariki port. Two oil engineers at the field said. In U.S. supply, the U.S. oil rig count, an indication of future supply, rose 6 to 580 this week, their highest since March of 2020. Prospects are receding for reaching a nuclear deal with Iran and lifting U.S. sanctions on the Iranian energy sector. Iran on Thursday dealt a near-fatal blow to chances of reviving the nuclear deal as it began removing essentially all of the International Atomic Energy Agency monitoring equipment installed under the deal, IAEA Chief Rafael Grossi said. So, not good. And I don't understand why China is shutting everything down. I mean, it's become abundantly, clear at this point. If you're under the age of like 60, 70, catching this cold is not going to kill you. So, well, unless you're a big fat person. I mean, if you're overweight and have diabetes, you get what you get. So I really don't feel sorry for anyone like that. All right, next article comes from Not the Bee, the Babylon Bees, site where they actually do some where it's not satirical. This one has to do with inflation. Come read this thread on why inflation is way worse than they're telling you. This comes from Tom Elliott. He's a journalist, as far as what I could tell. Breaking, U.S. annualized inflation just peaked 17% for the first time since World War II, the highest rate in 75 years. The media are misreporting the real data, and I'll explain why. All right, so the media is, where I read that part. So, and this chart comes from Shadow Charts. He explains who that is, shows what the red line is what we consider inflation, and the blue line is the inflation based upon how they calculated it back in 1980, and would put us at around 17% right now. So, really not good. All right, so let me go ahead and read through this real quick. Inflation is properly defined as an expansion of the money supply, not prices. However, in the 20th century, the federal government began a series of steps to expand the money supply to facilitate more expansive federal spending. Shock. Removing the gold standard, removing the gold peg, suppressing interest rates as stimulus, printing money directly into the treasury, etc. All of these are inflationary, and prices rose far more in the 20th century versus the largely deflationary 19th century. To cover their tracks, the Fed changed its definition of inflation from meaning an expansion in the money supply to mean rising prices. Again, previously, the terms were basically synonymous, as an expanding money supply always means higher prices. The CPI, as originally conceived, was intended to track the cost of maintaining a constant standard of living. In 1980, the Fed altered its tool for calculating inflation such that it was no longer measuring a constant, quote, basket of goods, but rather a quasi-substitution-based basket of goods, now via hedonics. The Fed would, for example, use tech improvements to offset rising prices, i.e., if a computer is 25% faster than the year prior, but the price remained the same, the Fed claimed a 25% price drop in generalized computing power, which enabled them to suppress headline CPI numbers on net. In 1990, the Fed again evolved the CPI so that these tricks for downplaying, quote, official inflation were exacerbated. Unfortunately, the major media reports whatever Washington feeds them, as if this shape-shifting measuring stick is actually useful to consumers. Thankfully, consistent data is available via Shadow Stats, where economist John Williams updates inflation data using the Fed's original CPI calculator. Most of the data is behind a paywall, but you can still see how the official data is now slightly less than half of what it would be if it were still using the CPI tool used up until 1980. The first percentages are the CPI official numbers. The percentages on the right are the inflation using the original measuring stick. As you can see, this year, the real inflation numbers are slightly more than 2 times the official numbers at the beginning of the data set. You can see how these percentages matched. Shadow Stats hasn't updated for May yet, but if current trends hold, and probably they will only worsen, May's annualized inflation rate will be just north of 17%. As a reminder, the worst of Jimmy Carter's stagflation era topped out at 14.5%. This year, we'll soon see Americans losing 20% of the value of their paychecks through inflation alone. That's a horrible shock to Main Street, and unfortunately, there's no reason for optimism. The Fed continues suppressing interest rates and was still printing money last month. That is true. I probably covered that I know I covered it in a recent video showing the M2 number continuing to rise, even as they claim that they're trying to squash inflation. The crisis will only abate once Congress drastically slashes spending and the Fed jacks up interest rates to unforeseen levels, the effects of which will be a huge recession. The Biden admin doesn't want a recession on their watch, so will likely try papering over the crisis with more handouts. which, as we all know, only makes things worse while pushing off the actual reckoning further into the future. The worst part about this, inflation always punishes the poor the hardest. So what happens when you combine the social decay we've witnessed over the last several years with skyrocketing inflation, supply chain breakdowns, food shortages, and collapsing institutions? We'll soon see. So yeah, it is ugly. It is ugly out there, folks. All righty. More good news on the Social Security front. Social Security whistling past the $96 trillion graveyard comes from Zero Hedge. Social Security has a problem as Democrats push to expand entitlements to include free preschool and subsidized childcare. Little attention is getting paid to Social Security. Social Security is a financial train wreck. Quote, the program's payouts have exceeded revenue since 2010, but the recent past is nowhere near as grim as the future. According to the latest annual report by Social Security trustees, the gap between promised benefits and future payroll tax revenue has reached a staggering $59.8 trillion. That gap is $6.8 trillion larger than it was just 1 year earlier. Excuse me. The biggest driver of that wasn't COVID-19, but rather a lowering of expected fertility over the coming decades. It comes from stark realities. Note that last sentence. When President Roosevelt first enacted Social Security in 1935, the intention was to serve as a safety net for the elderly. However, at that time, the life expectancy was roughly 60 years of age. Therefore, expectations were that participants would not be drawing on Social Security for very long from an actuarial basis. Furthermore, roughly 16 workers paid into Social Security for each welfare recipient. Of course, given that politicians like to use government coffers to buy votes, additional amendments got added to Social Security to expand the participation in the program. Such included adding domestic labor in 1950 and widows and orphans in 1956. They lowered the retirement age to 62 in 1961 and increased benefits in 1972. These then politicians added more beneficiaries from the disabled to immigrants, farmers, railroad workers, firefighters, ministers, federal, state, and local government employees, etc. While politicians and voters continue to add more beneficiaries to the welfare program, the number of workers steadily declined. Today, there are barely 2 workers for each beneficiary. Quote, politicians promised you benefits, but never funded them. That's according to truthinaccounting.org, which noted there's a $96.3 trillion owed in promised but unfunded Medicare and Social Security benefits, $55.1 trillion for Medicare and $41.2 trillion for Social Security. While Uncle Sam has $5.9 trillion in assets, the $129 trillion owed in bills, including military and civilian retirement benefits, means the U.S. is in the hole for $123 trillion. Just the unfunded liabilities in Medicare and Social Security add up to $96 trillion. It's a stunning amount coming due over the next 75 years. The Treasury Department sticks its proverbial head in the sand and does not even list the liabilities on the balance sheet of the federal government. Adam Andruski. Let that soak in for a minute. According to the Social Security Trustees Annual Report, the Social Security program will be insolvent in 13 years by 2035. At present, the program cannot guarantee full benefits to current retirees. The Social Security Old Age and Survivor Insurance Trust will deplete its reserves by 2034. Awesome news! The Social Security Disability Insurance Trust Fund is better financially. However, the combined trust fund will deplete by 2035 when today's youngest retirees turn 75 and 54-year-olds enter full retirement age. Once the program becomes insolvent, all beneficiaries will face across-the-board benefits cuts of 20%. In 2022, the trustees estimate Social Security to run a cash flow deficit of $112 billion, which comes to 1.3% of taxable payroll. Over the next decade, Social Security will run deficits of almost $2.5 trillion, equivalent to 0.8% of GDP or 2.1% of taxable payroll. By 2040, the annual deficit will grow to 3.4% of taxable payroll, moving even higher to 4.3% by 2096. Is it an insurmountable problem? Currently, most people suggest a few minor tweaks, such as increasing the retirement age, can solve long-term funding. How do we do this? Because adjustments made previously to the welfare program still fell well short of future assumptions. For example, in 1977, when Congress passed an amendment that altered the tax formulas to raise more money, increasing withholding from 2% to 6.15%, as President Carter remarked, quote, now this legislation will guarantee from 1980 to the year 2030, the Social Security funds will be sound, end quote. Yeah, let's see how that worked out. Financial picture declined almost immediately, and by the early 1980s, the system was again in crisis. Then in 1983, a panel investigated the long-run solvency of Social Security, and in 1983, amendments were put in place to raise Social Security taxes and raise the full retirement age. Once again, these fixes failed to fix the long-term funding problem of the welfare program, for the simple reason that increasing taxes and a declining number of individuals won't cover the growing number of welfare recipients. Today, the problem remains the same. Increasing taxes and extending retirement ages won't solve the long-term insolvency of too many beneficiaries. The only real reality is that eventually the benefits promised to the elderly will not get paid in full, or the younger generation who vote for socialism will be saddled with trillions in extra taxes with nothing in return. And let me jump down here a little bit further. Let's see here. Really, the biggest problem is just the birth rate has continued to fall. You can see here in the early 70s, when things were so bad, the birth rate, kind of bottomed out. And then in the 80s, it climbed up again. And here in this latest decade, it has started to really, really fall again. So, and it shows here the number of old people, which is the red line, versus the number of young people who are paying into the system. These lines are about to cross right here. So not a good thing. All right, jumping back in. As millions of baby boomers begin to retire, another problem also emerges. Demographic trends are relatively easy to forecast and predict. However, each year until 2025, we will see successive rounds of boomers reach the 62-year-old threshold. There's a twofold problem. As the successive crops of boomers head into retirement, first, each boomer has not produced enough children to replace themselves. Such leads to a decline in the number of tax-paying workers. It talks about 25 years to grow a new taxpayer. We can estimate with surprising accuracy how many people born in a particular year will live to retirement. The retirees of 2070 were born in 2003. And we can see and count them today. The second problem is the employment problem. The decline in economic prosperity discussed previously is caused by excessive debt and declining income growth due to productivity increases. Furthermore, the shift from manufacturing to a service-based society will continue to lead to reduced taxable incomes. The employment problem is critical. By 2025, each married couple will pay Social Security retirement benefits for one retiree and their own family's expenses. Therefore, either taxes must rise or other government services must be cut. I'm in favor of that. Fire everyone who works for the federal government today, and let's pay down the debt and get things back solvent. Back in 1966, each employee shouldered $550 of social benefits. Today, each employee has to support more than $18,000 worth of benefits. The trend is unsustainable unless wages or employment increases dramatically, and based on current trends, such seems unlikely. The entire social support framework faces an inevitable conclusion where wishful thinking will not change that outcome. The question is whether elected leaders will make needed changes now or later when they are forced upon us. For now, we continue to whistle past the $96 trillion graveyards. Isn't that great news? I mean, our legislators and politicians continue to just, bleed us dry with taxes and, just ignore the problem. I mean, it must be great to work for the government where you never pay any tax into the system and, you get to reap the benefits of, everyone else working really, really hard. All right. Well, I'm going to try to leave you with some good news or, maybe a good idea. This last one is Elon Musk recommends investing in physical things. Here are 3 physical assets that perform well during high inflation, written by Kevin Vandenboss. CEO Elon Musk posted in a thread on Twitter in March after inflation hit a 40-year high for the first time this year, advising followers to own physical things when inflation is high. Not a bad idea. In the tweet, Musk said, quote, as a general principle for those looking for advice from this thread, it is generally better to own physical things like a home or a stock in companies you think make good products than dollars when inflation is high. I still own and won't sell my Bitcoin, Ethereum, or Doge for what it's worth, end quote. The biggest takeaway for followers seems to have been that Musk still holding his Dogecoin because the cryptocurrency's price saw a temporary spike shortly after the tweet. However, the more important point to Musk's message is that physical assets are generally the safest investment during times of high inflation. This message coming from the Doge father himself. should speak volumes. With the unexpected news of 8.6% rise in the consumer price index for May, was it really unexpected? Really? I mean, come on. For May, after April's data suggested inflation was beginning to cool off, I don't know why anyone thought that, it's becoming increasingly important for investors to consider diversifying their portfolios with physical assets. Here are three that have historically performed well during periods of high inflation. Real estate. While Musk referenced owning a home, real estate in general performs well for investors during years of high inflation, specifically single-family homes, multifamily, and self-storage and farmland. Running out to buy property may not be the most feasible option for most investors right now, but luckily there are options available to buy shares of fractionalized real estate. Investors can buy shares of rental properties for as little as $100, or invest in build-to-rent communities and large-scale multifamily developments in some of the fastest growing communities in the country. There are also real estate funds with low minimum investments that offer exposure to a diversified portfolio of properties, including single-family rentals, multifamily, and commercial properties. Knowing or with all the change in the job landscape, I would probably be a little leery or careful with commercial properties simply because we don't know what's going to happen. Is this work from home generation really going to take off? Is it not? So I know a lot of companies are fighting with that, trying to get people back into the office. But anyways, next is fine art. Art has been a popular method of storing wealth for generations. There is no surprise considering that it has outperformed the S&P 500 for the past 25 years and appreciates at an average of 23.2% in years where inflation is at least 3%. This type of investment used to be available only to the ultra wealthy. However, retail investors now have the option to buy shares of valuable works or invest in art funds. And last is wine. The LivX Fine Wine 1000 index has performed quite well this year as inflation has been soaring. The index, which tracks 1,000 wines from across the world, is up 10.3% year to date and 25.6% over the past 12 months. Retail investors have gained access to this market by purchasing securitized fractions of wine collections, as well as buying and selling individual bottles through investment platforms. The article was really published back in March 15th, 2022, and updated on June 10th. All right. So again, it's not like everything is falling apart at this point, but at the same time, you just want to be smart about your money decisions. So, having your assets in stuff right now probably makes more sense than keeping it in cash or, the highly volatile tech sector. So, the tech sector's had a really nice run for more than a decade, and a lot of that's been helped out by interest rates kept at, basically zero since the financial meltdown back in 2008. So, all right. Well, that's everything I had for today. I hope everyone has a fantastic weekend. I'll be back on Monday with the weekly update. And if anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there if you want to give me a call, book a meeting, or just read through all the interesting stuff I put on there. It's really entertaining. All righty. Well, hope everyone has a great weekend, and I'll talk to you later. Bye-bye.